Hello guys and welcome back to another video on my channel. Thank you so much for the support we've been receiving lately. It means a lot to us to keep continuing making more videos for you every day. So thank you for all the follows, likes, views and comments. It really means a lot to us, and hopefully we'll do the same thing in this video. If you're new to this channel, please subscribe because we post daily insightful information about this new technology of the order flow. So today we'll be talking about everything you need to know about the futures market, which is the market we trade using the order flow. So what is a futures market? Well, traders buy and sell predictions on price movement, agree on a price today, and buy the goods when ready at a price agreed upon before. So now, for example, let's say I'm a farmer. I'm gonna sell you corn, which today is 13th May. Let's say I will have the corn ready by end of July. Well, you as a buyer want to buy tons amounts of corn from me, okay? So what do is we agree on a price today. If the price is higher at that time or even less, that's not our problem. We just buy and sell regarding to the price we have agreed on today. So why do we do this? To stabilize the kerosene prices, oil prices, gold, and all the major things you know about the market. So let's say, for example, you want to buy corn from me. So you might agree on $3 today per kilogram, okay? So you might agree on $3 per kilogram. By the time July is here, if the price is $5 per kilogram or $1 per kilogram, well, we have an agreement to buy at $3 only, okay? So the price of that time doesn't really inflate or does any effect to the price we agreed upon today. So let's say, for example, why do companies need to use futures contracts? Well, let's say, for example, you are a big, massive, huge airline. You need to calculate all the costs today. So that is why they do futures market prices for kerosene, for oil they need to to make the planes moving, okay? So what they do is they agree with the company on a price. That's how they calculate the cost of a flight, because you cannot just wait until the day of the flight and then be like, oh, what's the price of oil today? It doesn't work like this for airplanes. They need to calculate everything before, and that is why they use these prices so they can control the market. That's where the market always stays in control. Even though there is war or anything, the market stays stabilized. That is why if futures market didn't exist, the Iran war could have inflated the market by far. The price would go up in the same day, and then they would have to buy it for a higher price, which means double the prices for airplane tickets. So that is why kerosene always tend to stabilize markets and make them stable. So what does this have to do with order flow and with trading in general? That's what we're gonna find out now. So futures contract explained. Every contract has an asset, a price, and an expiration date. So most traders never receive the actual asset, but they just trade it for various reasons that I cannot cite on the video. I need so much to explain it to you guys, and actually you don't really need to understand that. You just have to know what's a futures market and why does it exist, so they just know what are you trading. So that's a brief explanation of how the futures market works. So let's say the current price is $50. We agree on the $50 on the day of delivery, time of expiry here. If price is higher, we buy at the agreed price 50. If price is lower, you are obliged to settle the contract at agreed price, which is $50. If it costs $10 for another customer that I trade with, then you have to pay me $50 even, because we have a contract that we agreed on the first day. So why futures were created? They were originally made for businesses to reduce uncertainty. Same thing I explained before for kerosene companies. It helps companies lock prices ahead of time. So that just helps them understand the cost and everything they need to spend. It also protects against sudden market changes. As I cited before, the Iran war as an example. So we also have speculation and traders, and this is the part where we get involved. Speculators try to profit from price movement. They don't care about owning the asset, they just analyze news, charts, volume, and economic data. So futures attract day traders because of volatility. It's one of the most volatile market you can find in the market. So what's good about it is just you can just buy. You can also sell and make a profit. If you sell, the price goes down. You buy, you make a profit. If you sell, the price goes up. You make a loss. If you buy and price goes up and you sell, you make profit. If you buy and the price goes down, that's what you lose. So that's what is interesting about the futures market. So let's give you some examples of the futures market. I explained some for you here, some were cited on the picture, some were not. So oil futures, you can say the commodity futures in general, oil, wheat, goods, and also gold. So it's one of the biggest futures market and they influence energy prices worldwide. I already explained that to you. Second one is stock futures, which is the one we trade based on indexes like the S&P 500 or the Nasdaq. It shows market sentiment before stock market even opens because the market is open 24/7, unlike the S&P 500 index only opens from 8:30 to 5:30 Chicago time. So we also have crypto futures, which is very popular because of leverage and it's highly volatile. Then we also have interest rates and bonds and everything related to the American government. Then we have currency, sorry for the mistake, currency futures. For example, there's euro futures and many other currencies that you can trade on. So next we'll be moving to the S&P 500. The technical name for it in the market is E-mini S&P 500. It's one of the most traded futures market in the world because of its stability and volatility at the same time. It tracks the S&P 500 index and traders use it to speculate on the overall US stock market. It also trades almost 24 hours a day, so you can trade it in Asian, European, and American session. It's highly liquid, so there's easy entries and exits. So you should understand that for each move, I could have explained this better, but I'm gonna do it here. So futures moving points, it's not like a lot, okay? So you have something called a tick, and each point have 4 ticks. So if you go up by 1 tick, that's 12.50. If you go up by another tick, that's $25 that you made or lost. If you go by another one again, that's 3 ticks, 37.50, and then you accomplish 1 point, which is $50. So if price moves 10 points, you lost or you won $500 per contract. This you can also improve. You can add contracts, it could be 1,000. But what you should know is that we move up by 1 tick, which is 12.5, and we move down by 1 tick, which is 12.5. So the point system in futures, as you can see, oh, I said the same thing again, I'm sorry. Okay, explains it here. So this is the one we trade. That's a lower market, that's full size, that's very risky. This one is the people trade, this is what people trade the most, which is the E-mini S&P 500. So a tick value is 12.50. 4 ticks, you have 1 point, which is $50. We move by 0.25 point, okay? So the market moves 0.25 to 0.50, 0.75, and then 0. And it keeps on going up or down. So we have exchange fees for every contract, $1.18. So for each contract you take, you have to pay $1.18, no matter you lost or won, to the broker, to the fees in general, okay? So, for example, if you lost $50, you lost 51.18. If you won $50, you won 48 something, 48.70.82, okay? $48.82, for example, and the list keeps on going. So why order flow is powerful in futures? First of all, the futures markets are centralized. Traders can see real buying and selling activity. It's more transparent than Forex or some crypto markets. And also the order flow shows aggressive buyers, aggressive sellers, liquidity, large institutional activity, and areas where price may reverse. So why futures are great for the order flow? First of all, you have real volume data. You can see that the futures provide more data than commodities and CFD market for example, CFD stands for contract for difference. That's another market. I'm gonna try to explain it to you in another video, but we don't really use that in the order flow, just for you to know. You also have high liquidity, you have institutional participation, tight spreads, and fast execution. And this is what makes the combination between futures and order flow so great. So thank you guys so much for your time. If you stayed till the end, I really appreciate it. And please do let me know if you have any questions about the futures market. And if you want to know anything about the order flow, just go to my channel. If you cannot find the answer, just send me a comment and I will try to help you as soon as possible. This was Ethan from Order Flow with Ethan, and thank you for your time.